So usually when we talk about taking the temperature of the global economy, there's this underlying assumption that you have to look at Wall Street.
Right, yeah.
You know, you look at the big commercial banks, or like you track the massive semiconductor manufacturers, or maybe you're just watching the stock tickers flashing red and green on a trading floor.
Yeah, the general consensus is always that those digital numbers represent, you know, the heartbeat of the world.
Exactly. But then you step out of the financial district, you step away from the trading desks, and you realize something quite profound about how the world actually operates.
Which is?
Well, the best barometer for the global economy, like the true leading indicator for where humanity is actually heading, it isn't a centralized bank at all. It's a company that builds tractors.
Oh, absolutely. It's really the ultimate reality check. I mean, we have this tendency to view the modern economy as this abstract, almost frictionless system.
Right. It's very clean.
Extremely clean and heavily digitized. We imagine global commerce just living on a server somewhere in a major metropolitan hub, completely detached from the physical world.
But heavy manufacturing is the literal definition of where the rubber, or I guess the tank, treads meets the dirt.
Yeah. You cannot build the physical infrastructure of the future, and you certainly cannot feed the global population using only software. You need heavy metal.
And that concept is our mission for you today. Welcome to this deep dive. We are Talk Tickers, and we're here to break down corporate earnings calls for you, the retail investor.
That's right.
And today, we're going to take a single dense corporate update, specifically the Q2 2026 earnings call of Deere and Company, and we are going to completely unpack it.
Because hiding inside this one quarterly financial report is just a fascinating tangled web.
It really is. We are going to explore global geopolitics, incredibly complex high-tech supply chains, the secondary physical ripple effects of the artificial intelligence boom.
Which is huge right now.
Massive, and literally the future of how we produce our food.
Because a company like Deere sits at the absolute intersection of all these macroeconomic forces.
Yeah.
I mean, you can't just build a modern $500,000 combine harvester without touching international trade policy or global commodity markets or advanced robotics.
And satellite telecommunications, right? Every single one of those elements is baked into the machine.
Exactly.
So to really grasp the scale of what we're looking at, I want to start with a baseline reality check to ground you in the headline numbers, because we are data forward here.
Always. Let's hear the numbers.
Okay, looking at my notes for these Q2 2026 results, Deere posted a frankly unexpected 5% year-over-year growth in net sales and revenues.
Which is wild in this market.
Totally wild. They hit somewhere north of $13.36 billion for the quarter.
Wow.
Yeah. And if we isolate just their equipment operations, like just the physical machines, that pulled in nearly $11.77 billion.
But the margin is the crazy part, right?
Oh, the margin is what really caught my eye. They are sitting on a staggering 16.9% operating margin.
Unbelievable.
And the net income landed at about $1.77 billion, which translates to $6.55 per share.
We really should pause and just fully appreciate that 16.9% margin on the equipment operations.
Right, because that's not normal.
No, it's not. Hitting margins approaching 17% while you're building massive, capital-intensive physical machines made of forged steel and advanced silicon. That is extraordinary.
Right, you usually only see that in software, don't you?
Exactly. That's a level of profitability you occasionally see in highly scalable SaaS companies. You almost never see it in heavy industry.
Especially not right now.
Yeah, especially not in the middle of a volatile global market where supply chains are constantly fracturing.
So I was trying to conceptualize how they're pulling off those numbers when the global economy feels so, erratic right now. And looking at this company is like watching a massive heavy lift cargo plane flying through intense macroeconomic turbulence.
I like that analogy.
Right now, this particular plane has 3 distinct engines powering it forward, and those engines represent their 3 main business units.
Okay, break that down for us.
Well, if you look out the window, those engines are operating at totally different points in their life cycles. One engine is sputtering and coughing, clearly struggling.
Yep.
Another engine is just humming along beautifully, totally stable. And the third engine is an absolute full throttle afterburner, just pushing the whole operation forward.
That visualization captures their internal dynamics perfectly. Because in the world of industrial manufacturing, what you just described is known as cycle diversification.
Cycle diversification. Plain language that for me.
Basically, it's the holy grail for a legacy company. Historically, heavy equipment manufacturers were deeply, painfully cyclical.
Like boom and bust.
Exactly. If the global agriculture market crashed, the entire company would crash right alongside it. If construction slowed down, the whole company would bleed cash and have to lay off thousands of workers.
Oh, I see.
But what the 2026 data reveals is that Deere has managed to uncouple the cycles of its different divisions. They are no longer completely dependent on a single macroeconomic factor.
Which explains why their management team hasn't panicked at all, despite some clear trouble spots.
Right. It is the primary reason they confidently maintain their full year 2026 net income forecast.
What was that forecast again?
They're projecting $4.5 to $5 billion in net income and equipment cash flow of $4.5 to $5.5 billion.
That's a huge safety net.
It is. They are holding firm on those numbers despite facing undeniable massive headwinds in certain sectors. The humming engine and the afterburner are generating enough thrust to compensate for the sputtering one.
Well, let's examine that sputtering engine first, because it represents a massive chunk of their historical identity.
Yeah, the large ag stuff.
Right, the production and precision ag business. These are the massive combine harvesters, the enormous high horsepower tractors with 8 wheels that pull like planting implements the size of a suburban street.
They are literal monsters.
They are. But net sales in the segment dropped 14%, falling down to roughly $4.5 billion for the quarter. Yeah, and management didn't try to sugarcoat the situation at all. They explicitly called 2026 the, quote, bottom of the ag cycle.
You know, when an executive team uses a phrase like the bottom of the cycle on a public earnings call, they are signaling a highly defensive posture for that specific division.
Right, because taking a 14% drop in revenue is a heavy blow to absorb.
It really is. It indicates that farmers are hoarding their capital. They're delaying their equipment upgrades, canceling their pre-orders, and choosing to run their existing older fleets longer and harder out in the fields.
To really understand why that specific engine is sputtering so badly, the sources suggest we have to zoom in on a specific geographic microcosm.
South America, right?
Specifically Brazil. The data shows that the overall agricultural equipment industry in Brazil has declined about 15% over just a 6-month period.
That is a breathtakingly steep drop-off for a major market.
It's basically a cliff.
And you have to understand, Brazil functions as a bellwether for the entire global agricultural machinery market.
Really? Why Brazil?
The sheer scale of their farming operations in places like Mato Grosso is difficult to comprehend until you see it. They are massive. And they're also aggressive early adopters of new technology.
Oh.
So when the Brazilian farmer suddenly stops buying equipment, the entire global industry feels the shockwave immediately.
But the sources point to a very specific reason why they're hurting so badly right now. And this is where we start connecting some really fascinating geopolitical dots.
Right, the Iran situation.
Exactly. The report points directly to the ongoing conflict in Iran. Now, as a listener, you might naturally wonder, what does a geopolitical conflict in the Middle East have to do with a farmer trying to plant soybeans in central Brazil?
It seems disconnected, but it's not. It comes down to the underlying chemistry and economics of modern farming.
Explain that connection for us.
Modern agriculture is entirely dependent on 2 critical inputs: fuel to run the machines and fertilizer to feed the crops. And both of those inputs are deeply structurally tied to global energy markets. Nitrogen fertilizer, for instance, requires massive amounts of natural gas to produce.
I didn't know that.
Yeah, it's energy intensive. So when a conflict in Iran threatens the stability of the Middle East, it sends immediate shockwaves through the global energy supply chain.
Causing prices to spike.
Exactly. That geopolitical tension caused localized spikes and severe, unpredictable volatility in the spot prices of both oil and fertilizer ingredients.
Well, I have to play devil's advocate here for a second, because looking at the broader commodity markets, there seems to be a glaring contradiction.
What's that?
U.S. commodity prices for crops like corn and soybeans have actually risen about 20% since last August.
Right.
So if the global price of the crop is up, meaning the farmer is theoretically getting paid significantly more money for the exact same yield, why is their sentiment so muted?
The correct question.
Why are they so terrified to buy a new tractor if their crops are worth more?
This brings up an incredibly important concept in agricultural economics, which is the timing of the lock-in.
The timing of the lock-in.
Yeah, you have to look at the calendar and you have to look at the geographic location of the specific farmer. The global agricultural cycle is not perfectly synchronized. The seasons dictate the finances.
Walk me through a scenario to explain that timing difference. Let's start with a farmer in the American Midwest.
Sure. Consider a corn farmer in Iowa. They typically plan their season and lock in the prices for their essential inputs, their diesel fuel, their nitrogen fertilizer, their bulk seeds, months and months before their spring planting season even begins.
So they're buying ahead.
Right. They might be locking in those contracts in the dead of winter. Because they locked in their costs earlier in the year, they secured those inputs way before the geopolitical situation in Iran deteriorated and spiked the global spot prices.
Oh, wow. So they are essentially grandfathered into the cheaper operating costs for this current growing season.
They are completely insulated for the moment. They're currently enjoying the financial benefit of those 20% higher global crop prices when they sell, but they aren't feeling the sting of the hyperinflated fertilizer costs because their tanks were already full.
That makes perfect sense. But the Brazilian farmer is operating on a totally different seasonal clock because they are in the southern hemisphere.
Exactly. The Brazilian farmer is preparing to plant their primary crops in the September timeframe.
Right.
Which means they are actively out in the market right now trying to secure their fertilizer and fuel. They are fully exposed to the current geopolitically inflated spot prices.
Dude, because they couldn't buy it 6 months ago.
Right. They didn't have the luxury of locking in those costs.
Sure.
So even though the global price of soybeans is decent right now, the sheer cost to grow that acre of soybeans has skyrocketed for them in real time. The margin's just vanishing.
Man, that's rough. And the sources also mention that it isn't just the geopolitics of fertilizer squeezing them. There are local macroeconomic factors compounding the pain in Brazil, too.
Oh, absolutely. You have to layer the domestic monetary policy on top of the geopolitical issues. Interest rates in Brazil remain punishingly high right now.
And tractors aren't cheap.
No, they are not. When you're looking at financing a multi-$100,000 piece of heavy equipment, high interest rates can completely destroy the return on investment. The monthly payment just becomes untenable.
Right.
Furthermore, the Brazilian real has been quite strong against the US dollar recently.
And a strong local currency is actually a bad thing if you are trying to sell your goods on the international market, right?
Yeah, it acts like an invisible tax on their exports. Because global commodities are priced in US dollars, a strong Brazilian real makes their agricultural exports less competitive globally.
So they make less local currency.
Exactly. It squeezes the actual profit they take home. So you combine hyper-expensive fertilizer, brutal borrowing costs, and a currency dynamic that hurts your export power. And the result is a 15% drop in tractor sales.
It's a perfect storm of margin compression for the grower.
It really is.
But despite all of that gloom, despite being squarely at the very bottom of the cycle in South America, I noticed a really surprising silver lining in the sources.
The market share data.
Yes. And I think it is a testament to how Deere's management actually handles a downturn, which is a massive signal for anyone holding the stock.
Right. For the retail investor, this is key.
Even in this brutal environment, Deere is actively gaining market share across all tractor categories in Brazil. In fact, they are accelerating their portfolio innovation.
They're leaning in.
They really are. They just executed a massive global launch specifically centered in Brazil, rolling out over 20 new products and technology solutions simultaneously.
Which is crazy timing.
And they are somehow maintaining double-digit profit margins in that region. I mean, how do you launch 20 new products into a collapsing market and still hold your margins?
It is a textbook example of utilizing a cyclical downturn to widen your competitive moat.
Widen the moat.
Exactly. When a market contracts violently, weaker competitors inevitably pull back. They slash their research and development budgets. They cut their marketing spend.
Just to survive.
Right. They delay new product launches just to conserve cash. Deere is executing the exact opposite strategy.
Because they have the cash to do it.
Yes. By launching 20 brand new, highly advanced tech solutions at the absolute bottom of the market, they are sending a very clear psychological signal to the Brazilian farmer.
What's the signal?
They're saying, we are stable, we are continuously innovating, and these specific new tools are engineered to help you survive this exact margin squeeze you're experiencing.
Oh, wow. So they are selling efficiency when the farmer needs it most.
Exactly. And by maintaining double-digit margins while aggressively launching products, it proves that their pricing power and their internal operational efficiencies are deeply embedded in the company culture.
They aren't just buying market share by slashing prices.
No, they are winning on technological superiority.
That's a massive bullish signal for long-term holders. So that covers the sputtering engine. Large ag is taking a significant hit, but the company is managing the descent gracefully and setting themselves up for the rebound.
Right.
Now, let's pivot to the second engine on our plane, the humming engine. This represents the small ag and turf segment.
This division really provided a massive bright spot in the overall quarterly report.
It's a fascinating contrast. I mean, while large ag was dropping 14%, the small ag and turf segment saw a massive 16% revenue jump.
It's a huge swing.
Bringing in nearly $3.5 billion.
Wow.
And the profit margins here were phenomenal, over 20% for the quarter.
Over 20%.
Yeah. To put that into perspective for you guys listening, selling riding lawnmowers, compact utility tractors, and golf course maintenance equipment is currently yielding better profit margins for the company than selling $500,000 highly complex combine harvesters.
Which feels entirely counterintuitive.
Yeah.
Until you dissect the underlying economic drivers.
Yeah.
We have to ask, what is actually funding this specific pocket of growth?
Right.
The data reveals two main factors. First, we are seeing a pronounced, sustained recovery in the commercial turf market.
Which was down for a while, right?
Yeah, we had a few years of industry decline, which was likely just a hangover from the massive pandemic-era boom in residential home landscaping where everyone bought a new mower.
Oh, right, because everyone was stuck at home.
Exactly. But now, commercial and high-end residential turf management is bouncing back aggressively. Golf courses are finally upgrading their aging maintenance fleets, and large-scale landscaping companies are renewing their equipment.
Okay, I get the golf course dynamic, but the sources also point to the dairy and livestock sectors as the second major driver.
Yes.
Why is a dairy farmer suddenly driving demand for this specific category of equipment?
It comes down to the frequency of their cash flow.
Frequency of cash flow.
Yeah. Unlike a row crop farmer who typically gets paid in massive episodic lumps once or twice a year at harvest time, dairy and livestock operations have a much more continuous, robust cash flow cycle.
Oh, because cows produce milk every day.
Exactly. Currently, those livestock sectors are experiencing very strong operational margins. Because money is flowing in steadily, they have the capital readily on hand to replace their utility equipment.
So things like skid steers.
Skid steers, small loader tractors used for moving feed, hay baling equipment.
Got it. There is another layer to this humming engine that I found really compelling, and it's something we don't naturally associate with lawnmowers and compact tractors.
It's foreign policy.
Yes. The sheer power of government policy. The sources detail how U.S. federal policy is acting as a massive structural safety net here.
It's huge.
It is essentially buffering the domestic agricultural sector and providing a steady, reliable baseline of demand for this mid-sized equipment.
When you connect these policy moves to the broader macroeconomic picture, the federal government is essentially putting a rigid floor under the market.
Let's break down the policy mechanisms doing this work. First, they point to the approval of higher renewable volume obligations, or RVOs. But let's put that in plain language for the listener. What does an RVO actually do in the real world?
In practical terms, the RVO is a legal mandate established by the EPA. It dictates the specific volume of renewable fuels like ethanol and biomass-based diesel that oil refiners and importers are legally required to blend into the nation's overall transportation fuel supply.
Okay.
By actively increasing the RVO mandate, the government is forcing a higher national consumption of commodities like soybeans, which are crushed and processed to manufacture that biodiesel.
So it isn't just about food consumption anymore.
Not at all.
The government is guaranteeing a massive industrial-scale buyer for the farmer's crop.
Exactly. It stabilizes their income by creating an artificial, legally mandated demand floor for the commodity.
That's a massive safety net. And the sources also mention significant changes to supplemental disaster relief.
Yeah, the program payment factors for federal disaster relief jumped from 35% to 70%.
No, it doubled.
It doubled. And this fundamentally alters the risk profile for a smaller farming operation. Well, if a mid-sized farmer gets wiped out by a severe drought or a catastrophic flood, the federal safety net catching them is now twice as strong as it was in previous years.
And how does that translate to tractor sales for Deere?
It gives those smaller agricultural operations the financial confidence to keep investing in their business infrastructure.
I see.
Instead of hoarding their cash in a bank account out of pure terror that a single bad weather event will bankrupt them, they feel secure enough to go finance a new utility tractor.
Right. And then there is the ethanol play, which seems to be a massive demand driver. The sources highlight the House's passage of year-round E15.
This is a game changer.
The transcript notes an incredible statistic. A third of all U.S. corn already goes toward ethanol production. A third.
Yeah, it's massive. So E15 is standard gasoline blended with 15% ethanol. Historically, the sale of E15 was heavily restricted during the hotter summer months due to legacy smog and emission regulations.
Right, you couldn't buy it everywhere in July.
Exactly. Approving E15 for year-round sale at the pump massively expands the total addressable market for ethanol.
Because they can sell it all year.
When gas stations can sell it 365 days a year, the refineries need to produce more of it, which directly translates to a massive, sustained, year-round expansion in the demand for American corn.
So synthesizing all of these background policies, the RVO mandates forcing soybean blending, the double disaster relief mitigating weather risk, the year-round expansion of the ethanol market, it becomes really clear that the government is intentionally propping up the baseline profitability of the smaller and mid-sized American farming operation.
They are engineering stability.
Right.
It completely offsets the localized geopolitical pain being felt in the large ag sector abroad. It's the core reason why, despite all the global volatility we discussed earlier, Deere can look at this specific small ag and turf segment and confidently project a 15% full-year sales bump.
15% bump in the middle of an ag trough.
Exactly. The domestic policy cushion is functioning exactly as intended.
Okay, so we've covered the sputtering engine of large ag and the steady humming engine of small ag and turf.
Now for the fun part.
Yes, now we need to focus our attention on the third engine, the one that is an absolute ear-shattering afterburner. This is the construction, forestry, and the AI infrastructure boom segment.
This division is the undeniable star of the entire quarterly report. The growth here is literally warping the overall numbers for the company.
The figures are just staggering. We are shifting our focus entirely away from agriculture and looking at heavy earth-moving equipment. Net sales in the construction and forestry segment exploded by 29% year over year.
Almost 30% growth.
Yeah, hitting nearly $3.8 billion for the quarter. Operating profit shot up to $561 million.
Incredible.
But the most shocking part is the forward-looking guidance. They have revised their full-year forecast for this segment upward, projecting an astonishing 20% overall growth.
A 20% growth projection for a mature heavy machinery division is almost unheard of.
Right, that's tech stock growth.
It is. You do not see those kinds of numbers unless there is a massive generational shift in capital expenditure happening across the broader physical economy.
And that is exactly what the data indicates is happening. I think the best way to understand this is to use the classic analogy of the gold rush.
Oh, the picks and shovels.
Exactly. During the gold rush, the people who consistently made the most money weren't usually the prospectors panning for gold. It was the merchants selling the picks and the shovels.
Yep.
You hear about the artificial intelligence boom constantly right now. Everyone is talking about NVIDIA chips, massive large language models, and the theoretical power of cloud computing.
Right.
But to build that digital cloud, you literally need to move millions of tons of physical dirt. You cannot have the artificial intelligence revolution without heavy metal.
It is the physical manifestation of the digital revolution. I mean, we talk about the cloud as if it is invisible, right?
Yeah, floating in the air.
But every single time you ask an AI to generate a block of code or render an image or process a massive data set, that complex computation happens inside a physical server rack.
Sitting in a building somewhere.
Exactly. Those thousands of racks live inside sprawling, million-square-foot data centers, and long before you can pour the concrete foundation for a facility of that scale, you need an armada of excavators, bulldozers, articulated dump trucks, and wheel loaders to prep the site.
And the sources put a hard financial number on the scale of this build-out.
What's the number?
The standout fact here is that data center construction alone is projected to top $100 billion in 2026.
$100 billion.
$100 billion allocated just for building the physical facilities. And they project that double-digit growth in this sector will extend well into 2027.
When you have $100 billion sloshing around a very specific subsector of commercial construction, the demand for the heavy equipment needed to execute those massive projects goes parabolic.
It has to.
But what is truly crucial to understand, and the sources make a point of highlighting this dynamic, is the ripple effect. The demand isn't limited to the massive bulldozers doing the initial site leveling.
Right. The infrastructure required extends far beyond the actual footprint of the building itself.
Absolutely. Data centers require colossal, almost incomprehensible amounts of electricity to run the servers. And crucially, they require millions of gallons of water to the cooling systems to keep those servers from melting down.
Because they run so hot.
Right. This means that greenlighting a single data center project triggers massive secondary demand for specialized water, sewer, and utility contractors in the surrounding area.
And those specialized contractors need their own fleets of equipment.
Exactly. They need specialized trenchers to lay miles of underground fiber optic cable. They need fleets of compact excavators to carefully dig the trenches for high-capacity water mains without hitting existing utilities.
Makes sense.
They need heavy lifting equipment to build entirely new electrical substations just to power the campus. The primary boom in the data center itself creates a massive secondary boom in underground utility infrastructure.
And AI isn't the only thing driving this engine either. The sources mention an absolute confluence of macroeconomic tailwinds hitting the construction sector simultaneously.
Like the infrastructure bill.
Right. You have the IIJA, the Infrastructure Investment and Jobs Act, pumping billions of federal dollars into road building, bridge repair, and civil projects.
Yep.
You have robust, sustained activity in the oil and gas sector. You have the continued, relentless build-out of massive warehousing and logistics centers for e-commerce.
It represents a synchronized boom across almost every facet of heavy civil construction. And Deere has positioned itself incredibly aggressively to capture this wave of capital.
Let's explore that positioning, because management isn't just sitting back and watching the orders roll in passively. They are actively doubling down on domestic production capabilities.
In North Carolina, right?
Yeah. The transcript notes a $70 million expansion at their manufacturing facility in Kernersville, North Carolina. They are now pumping out completely U.S.-designed and manufactured excavators.
Which is a highly strategic, calculated move.
Why is that so important right now?
In an era characterized by fractured global supply chains, unpredictable ocean freight, and rising geopolitical tensions, reshoring the manufacturing of your most in-demand earth-moving equipment to North Carolina is brilliant.
It skips the boats entirely.
Exactly. It insulates their production lines from international shipping bottlenecks and ensures they can deliver these machines to U.S. contractors rapidly, right when the demand is peaking.
And the demand from those contractors is absolutely rabid right now. The sources highlight that following the massive ConExpo trade show in 2026.
That's the big one.
Yeah, which had over 140,000 construction professionals in attendance. Following that show, nearly all of the production slots for the new John Deere excavator were already spoken for.
Sold out.
They are essentially sold out of these machines before the steel is even cut on the assembly line in Kernersville.
Wow. You know, when an industrial manufacturer has 80% or more of their production slots filled for the entire calendar year.
Yeah.
And an order book that has strengthened over 60% in a matter of a few months, that gives the management team incredible financial visibility.
It de-risks the whole year.
It does. It also gives them immense pricing power. They know the demand is locked in. That is why they can so confidently project 20% segment growth for the year. The afterburner is lit, and they have the fuel to keep it burning.
It's an incredible story for anyone looking at the stock. Okay, so we've established that the underlying business units are highly diversified and generally performing very strongly.
Right.
But to really understand this earnings call, we need to look at the financial mechanics operating beneath the surface. I want to look at the tariff tug of war and the margin magic they are pulling off.
Okay, let's get into the weeds.
There is a very interesting financial anomaly buried in this quarter's numbers.
You are referring to the unexpected windfall they reported.
Right. The overall quarter was significantly lifted by a $272 million recovery for refund claims related to specific agricultural and industrial protection tariffs.
Oh, wow.
This one-time influx of recovered cash boosted their operating margins by nearly $2.5 million. It looks fantastic on the spreadsheet for Q2.
It does look great on paper, but we have to separate that one-time accounting windfall from the underlying structural reality of their business.
Which is?
The underlying reality of the global trade environment right now is exceedingly harsh and incredibly expensive.
So break that structural headwind down for us. What are they actually facing when you remove that $272 million refund check?
You strip that away, Deere is facing a $1.2 billion full-year direct tariff exposure.
$1.2 billion, that's massive.
That is a massive punitive tax levied directly on their global supply chain. It translates to a full 3% headwind against their overall profit margins.
Wow.
Even when you credit the refund back into the mathematical equation, the net hit to the company for the year is still about $900 million in sheer tariff costs.
This raises a massive, glaring business question.
What's that?
If I am the CEO of a major manufacturing company and the government essentially slaps a $1.2 billion problem on my desk due to an escalating trade war or shifting import policies, the classic textbook response is simple. Pass the cost to the consumer. Why doesn't Deere just slap a 3% tariff surcharge on the final invoice for a new combine and force the end user to pay for it?
That is the obvious instinct for most corporations. Protect the margin at all costs.
Right.
But this is where we see an incredible level of disciplined restraint and strategic long-term thinking from Deere's management team. They explicitly chose not to implement punitive surcharges on their customers.
What is the strategic logic behind eating almost $1 billion in costs?
They possess a deep, empathetic understanding of their customers' current economic reality. We just spent a significant amount of time discussing how the Brazilian farmer is getting violently squeezed by high fertilizer costs.
Yeah, margins are vanishing.
And how global inflation is hurting profitability across the board. If Deere slaps a massive, unexpected surcharge on top of an already expensive piece of machinery, they risk destroying the demand entirely.
The customer would just walk away.
They would alienate their core customer base at the exact moment the customer is feeling the most financially vulnerable. The resentment would last for decades.
So how are they handling their pricing strategy instead?
They are keeping their net price realization targeted at a very modest 1.5 to 2% increase.
That's practically nothing.
Right. This figure is entirely consistent with general background inflation, completely excluding the punitive impact of the trade tariffs.
Wow.
They were essentially communicating to their market. We will raise prices slightly to match normal inflation, but we are going to absorb the pain of the geopolitical trade war so you don't have to.
Which is incredibly generous to the farmer or the contractor, but absolutely brutal for the corporate accounting department.
Oh, totally.
How on earth does a massive publicly traded company just eat a $900 million net cost without completely destroying their profitability? How do they pull off this margin magic?
You don't just passively absorb $1 billion hit. You have to actively engineer it out of your system.
And how are they doing that?
The sources detail a frantic but highly organized mitigation playbook being executed across the entire organization.
Like what?
They have dedicated teams of engineers and trade lawyers executing complex product certifications to definitively prove that certain specific components shouldn't technically be subject to the tariffs.
So they're fighting it on a part-by-part basis.
Exactly. They are submitting thousands of highly specific exemption requests to U.S. Customs, arguing that certain parts cannot be sourced domestically.
And they're re-architecting the physical supply chain itself, right?
Huge time. They are aggressively reevaluating where every single bolt is made. They are reshoring component manufacturing back to North America and maximizing their strict compliance with the USMCA, the trade agreement that replaced NAFTA.
Oh, wow.
They're literally rerouting how the physical parts of a tractor traverse the globe to minimize their exposure to taxable borders.
And they can only execute a pivot like that because of a massive foundational moat they've built over decades.
The domestic manufacturing footprint.
Exactly. The numbers here are vital to understanding their resilience to global shocks. The transcript notes that 80% of Deere's U.S. complete goods, like the fully assembled machines sold in America, are produced domestically.
80%.
80%. And of those machines built in the U.S., 75% of the internal components are sourced directly from U.S.-based suppliers.
That supply chain architecture is the ultimate hedge against a global trade war.
Because it stays inside the borders.
If you build a machine in America, utilizing American-made parts, you simply don't pay international tariffs on the bulk of your product.
And they are aggressively doubling down on this fortress strategy. They have backed it with a staggering $20 billion commitment to U.S. manufacturing facilities over the next 10 years.
$20 billion?
Yeah. They are essentially buying their way out of the international tariff problem through massive domestic capital expenditure.
It's a bold move.
It is. So they are protecting the customer from price shocks, absorbing the financial blow through ruthless operational efficiency, and building an impenetrable domestic manufacturing fortress.
It's an incredible balancing act.
But here is where we need to completely shift your perspective.
Okay.
Everything we have talked about so far, the supply chains, the factories in North Carolina, the heavy metal push and burn, is only half the story.
It really is just the physical shell of the product. The actual soul of the company has fundamentally changed over the last decade.
We need to completely reframe how you, the listener, perceive this company. John Deere is no longer just a tractor company.
No, not at all.
Based on the technology discussed in this earnings call, it is abundantly clear that they have transitioned into a robotics and software as a service tech giant. They just happen to package their proprietary kind inside green and yellow steel.
This represents the evolution from heavy metal to digital innovation. It is the exact point where iron meets silicon.
Let's look at the new 8 Series tractors they just launched, specifically the 8R and 8RX models.
Okay.
These machines are absolute monsters. They are pushing 440, 490, and up to 540 horsepower with this massive new JD14 engine.
Massive power.
Right. But when management talked about these tractors, the horsepower wasn't the headline.
What was?
The headline, the feature they stressed the most, is that these machines roll off the factory floor, quote, autonomy ready.
The phrase autonomy ready is a massive signal to the market.
What does that actually mean for the hardware?
It means the physical architecture of the tractor, the complex steering columns, the automated braking systems, the hydraulic valves, the sensor arrays, is already engineered to be handed over to a computer.
So the hardware is there.
The physical hardware is just sitting there waiting for the over-the-air software upgrade that will eventually remove the human operator from the cab entirely.
That is wild. And the technology they are deploying right now today is just mind-bending.
Yeah, let's talk about the precision tech.
Let's break down the specific tools they are using to combat those high input costs we talked about in the first segment. Remember how expensive nitrogen fertilizer and chemical herbicides are for the farmer?
Unbearably expensive.
Deere has engineered hardware that eliminates waste at a microscopic level. The sources detail systems with names like ExactShot, ExactRate, and FurrowVision.
To understand the value of these systems, we have to contrast them with how farming used to work.
Okay, paint that picture.
Historically, planting a field meant opening a long trench in the dirt and spraying a continuous, uninterrupted stream of expensive liquid fertilizer along the entire length of the row, just hoping the seeds would eventually absorb it as they grew.
Just spraying it everywhere.
Exactly. It is incredibly wasteful and environmentally taxing.
How does ExactShot change that dynamic?
ExactShot uses high-speed sensors to detect the exact millisecond a single seed drops from the planter into the soil.
Wait, it tracks individual seeds?
Individual seeds. The system then triggers a nozzle to squirt a tiny, perfectly calibrated dose of fertilizer directly onto that specific seed and nowhere else.
Wow.
It leaves the dirt between the seeds completely dry. It reduces total fertilizer use exponentially while maintaining the exact same crop yield.
That's unbelievable.
And FurrowVision uses downward-facing cameras to allow the farmer to physically see inside the trench and calibrate the depth of the planting from a high-definition touchscreen in the air-conditioned cab, all while rolling across the field at 10 miles an hour.
It's like a video game.
It really is.
But the crown jewel of this entire tech stack is the See and Spray system. We've touched on the concept of precision agriculture before, but the adoption rate highlighted in this call is exploding.
See and Spray is arguably the most important mechanical advancement in chemical application in decades.
How does it work?
It utilizes an array of high-resolution cameras and onboard processors mounted directly onto the massive sprayer booms extending from the tractor.
Okay.
As the machine drives over the field, the computer vision system analyzes the ground below it in milliseconds. The artificial intelligence has been trained on millions of images to differentiate between the specific crop you are trying to grow and an invasive weed trying to steal its nutrients.
So let me get this straight. If the camera sees a healthy soybean plant, the nozzle stays shut.
Right.
But if it sees a weed growing 2 inches away from the soybean, it triggers a single nozzle to blast just that specific weed with herbicide.
That is the exact mechanism. Instead of broadcasting thousands of gallons of expensive herbicides indiscriminately over the entire field, you are precision targeting only the active threats.
That has to save so much money.
Oh, it does. The sources note that this specific technology is consistently demonstrating a 50 to 60% savings on total herbicide costs for the farmer.
50 to 60%, that's massive.
That is a massive injection of margin right back into the farmer's pocket. And the technology is rapidly expanding. It's no longer limited to just corn and soybeans. They have updated the machine learning models to handle wheat, barley, and canola fields.
And they are introducing a derivative software called See and Scout, which I find brilliant.
What does that one do?
As those cameras are constantly scanning the ground for weeds, they are simultaneously generating massive, hyper-detailed, field-level data maps.
Oh, data collection.
Yeah. The software is doing stand counts, literally counting the total number of healthy plants per acre and mapping out specific weed pressure zones. The tractor isn't just a mechanical tool anymore, it's a data-gathering rover mapping the farm centimeter by centimeter.
But all of this incredible technology faces one critical bottleneck.
Which is?
To process these massive data maps, to download the updated AI algorithms, to allow the farmer to monitor a fleet of autonomous vehicles remotely from an iPad, you need a robust, high-speed internet connection.
And historically, farms are located in highly rural, isolated areas with absolutely abysmal cellular service.
Exactly. Dead zones everywhere.
Which brings us to the connectivity revelation, and what I think is one of the most unexpected yet perfectly logical corporate partnerships in the world right now.
Yeah.
John Deere has partnered with Elon Musk's Starlink.
It's brilliant. It solves the rural dead zone problem instantly and permanently.
They are deploying satellite dishes directly onto the roofs of the tractors, and the deployment numbers are wild. They have installed over 12,500 JD-Link boost kits, which are essentially ruggedized, vibration-proof Starlink terminals to combat these rural connectivity issues.
12,500 kits already.
Yes, and they achieved a 25% growth in kit deployments in just the last quarter alone.
Wow. If we connect this technological leap back to the underlying business model, this is where the software as a service magic truly happens.
The sauce multiple.
Right. By guaranteeing high-speed, low-latency internet connectivity anywhere on Earth via the Starlink constellation, Deere unlocks a full, inescapable potential of their digital ecosystem.
And what does that mean for the company's bottom line? Like, why is Wall Street so utterly obsessed with the sauce model?
Because it fundamentally transitions the company from a one-time transactional relationship to a highly lucrative recurring revenue model.
Okay, explain the difference.
In the old days, the transaction was, here is your tractor. Call us in 10 years when you need a new one.
Right.
Now, once a farmer starts using ExactShot and See and Spray, and they are uploading all their proprietary yield data to the John Deere Operations Center via a Starlink connection, they are deeply embedded in a high-value software ecosystem. They pay subscription fees to keep the software active.
The switching costs just become completely insurmountable for the customer.
The psychological and operational switching costs are massive. If a farmer decides they want to try and buy a competitor's tractor next cycle to save a few bucks, they lose access to years of highly calibrated, proprietary agronomic data that lives exclusively inside the Deere cloud.
Oh, that's brutal. They can't leave.
Nope. And the data from the earnings call proves the stickiness is very real. The transcript reveals that the Operations Center now boasts nearly 440,000 monthly active digital users.
440,000. That is roughly the population of a mid-sized American city logging into tractor management software every single month.
And the most critical metric for any software company is retention.
What's the retention rate?
The sources show that customers who renew their Precision Essentials software package into their second year have a retention rate of over 90%.
Of over 90%.
Once you learn to utilize the technology to save money on chemicals and boost your yield, you simply don't go back to farming the old, inefficient way. The recurring software revenue is rapidly becoming as valuable, if not more valuable, than the initial margin on the hardware.
See, that is why you hold the stock. That recurring revenue is bulletproof. But we have painted this picture of a highly advanced, satellite-connected, artificially intelligent fleet of machines roaming the earth. To fully grasp the business, we have to ground all of this digital theory back in the gritty, physical reality of the market. I want to talk about clearing the arteries and the physics of the dealer lot.
This is a great topic. This is where the soaring digital strategy collides with the harsh, on-the-ground reality of cyclical manufacturing.
We established early on that management strongly believes 2026 is the absolute bottom of the agricultural cycle.
Right.
But if they are currently sitting at the bottom, how are they actively preparing the business for the inevitable recovery they expect in 2027? This leads to a question that really stood out to me while I was reading through the sources.
What was it?
Why does an executive team that is fundamentally in the business of building and selling new machines spend so much time on their quarterly earnings call obsessing over the inventory levels of used machines?
It is a phenomenal question that cuts to the core of how heavy machinery is actually sold. You have to understand the critical role of the independent dealership lot.
Okay, the local dealer.
Yeah, the massive network of local dealers is essentially the vascular system of a company like Deere.
Let's stick with that anatomy analogy. How does that vascular system get clogged?
Think about the physical footprint and the financing of a local dealership. If a local dealer's physical lot is completely choked and overflowing with older, used equipment that they took in on trade, their floor plan credit line with the banks is totally maxed out.
Their floor plan credit line.
Yeah, the credit they use to buy inventory. Because all their available cash and credit is tied up in that aging, depreciating used metal sitting out in the sun. They physically and financially cannot accept any new trade-ins from farmers.
And that kills the primary mechanism for selling a new tractor.
Exactly. In this industry, almost every single new sale involves a trade-in.
So the farmer comes in with an old one to buy a new one.
Right. A farmer wants to trade in their 3-year-old tractor to help finance the purchase of the brand new 8 Series with the fancy Starlink dish and the See and Spray boom.
But the dealer says no.
If the dealer has to look at the farmer and say, "I'm sorry, I can't take your trade-in right now because I already have 6 identical machines sitting on my lot that I can't sell," the deal for the new machine dies instantly. The farmer walks away. The vascular system is completely clogged.
Wow. So to sell a new machine off the assembly line, corporate has to actively help the local dealer manage the disposal and flow of the used machines.
Yes.
What are the actual mechanics of that cleanup effort? How did they clear the lots?
The cleanup effort described in the sources has been monumental. It requires a highly coordinated strategy. Corporate often has to step in and offer financial rebates, subsidized financing rates, or special lease terms specifically designed to incentivize the purchase of used equipment by smaller operators just to get that metal off the primary dealer's lot.
Subsidizing the used stuff to make room.
Exactly. And the data shows this strategy is working. High horsepower tractor used inventories are down in the mid-teens, percentage-wise, from the peak of the cycle.
There is a specific metric in the report that is even more striking to me. They actively track the model year 22 to 23 8R tractors.
Oh, the popular ones.
Right, which were the absolute peak cycle, highly popular machines that flooded the market a few years ago. The used inventory of those specific tractors is down a massive 45% from their peak levels just last year.
Almost half.
Used combines are down in the mid-teens. Used sprayers are down 30%.
Achieving those reductions didn't happen by accident. It required Deere to sacrifice some short-term gains to ensure the long-term health of the dealer network.
And this massive cleanup effort sets up a fascinating strategic dynamic for the near future. If the dealer lots are finally clearing out, what does the corporate order book for new machines look like heading into 2027?
Well, the transcript notes that North American order velocity is currently tracking perfectly in line with their retail-driven production plans. But here is the truly genius counterintuitive move management is making.
What are they doing?
They are actively, intentionally underproducing.
Wait, let me make sure I understand that. They have the factory capacity to build more tractors, but they are purposefully keeping the assembly lines running slow.
Yes. They are restricting the supply of new machines.
Why?
By keeping the supply of new machines artificially tight while simultaneously aggressively clearing out the used machines from the dealer lots, they are dramatically altering the supply and demand curve out on the farm.
Okay, walk me through that.
Because the farmers aren't buying new machines at peak volume right now, due to the high interest rates and tight margins, their existing fleets are aging rapidly. The global pool of operating tractors is racking up higher and higher engine hours every single day.
The machines out in the dirt are getting tired.
Exactly. And eventually the physics of farming takes over, parts wear out, transmissions start to slip, maintenance downtime increases.
Which a farmer simply cannot afford during a narrow planting window.
Right. Eventually, the farmer has to replace the machine. They can delay the purchase for a year or two, but they cannot delay it forever.
So they're trapping them.
Not trapping, but positioning. By helping the dealers clear their lots now and intentionally letting the global fleet age and wear down, Deere is engineering a massive coiled spring effect in the market.
A coiled spring. So the moment the macroeconomic pressure finally eases, the moment central banks drop interest rates or global fertilizer prices normalize, or the Brazilian currency stabilizes, that coiled spring forcefully releases.
Boom. And when that pent-up demand finally releases, the local dealers will have empty, clean lots ready to accept trade-ins.
Right.
The farmers will have desperate, immediate replacement demand because their old machines are failing. And Deere will have the exact high-tech, autonomous, highly profitable portfolio ready to capture that massive wave of capital expenditure.
It is an absolute masterclass in long-term cycle management.
It's why they are best in class.
It really is. It's looking 3 or 4 moves ahead on the macroeconomic chessboard, refusing to panic over a bad quarter, and setting up the board for the next cycle. Let's try to synthesize everything we've uncovered today.
Yeah.
Because we started this deep dive looking at a single earnings call, which most people would assume is just a dry, boring financial document filled with accounting jargon.
Yes, they usually are.
But what it actually revealed is the profound, intricate interconnectedness of our modern world.
It is genuinely breathtaking when you step back and look at the whole system operating in concert.
Think about the chain of events we just tracked. You have the localized construction of an AI data center in Virginia, driving massive demand for heavy excavators.
Right.
The profit from selling those excavators offsets the financial pain caused by a geopolitical shockwave in Iran, which spiked oil prices and is currently crushing the margins of a soybean farmer in Brazil.
It's all connected.
You have billion-dollar international trade tariffs being quietly neutralized by teams of engineers physically rerouting component supply chains across North America to comply with the USMCA.
All behind the scenes.
You have a constellation of low Earth orbit satellites built by Elon Musk, beaming broadband signals to complex computer vision cameras, instructing a nozzle to fire a single drop of herbicide to kill a single weed in a massive field in Iowa.
Incredible.
All designed to save a farmer a few pennies on chemicals and lock them into a recurring software ecosystem. All of these massive, disparate global forces ultimately converge on a single patch of dirt.
And tracking those forces, it really forces us to challenge our preconceived notions of how the global economy is categorized.
It does. And I want to leave you, the listener, with a final provocative thought to mull over as you go about your day.
Okay, let's hear it.
We have historically categorized the economy into these neat siloed buckets to make it easier to understand. We have the tech sector, Silicon Valley, servers, apps, code. We have the agricultural sector, dirt, seeds, diesel, weather. We have the infrastructure sector, concrete, steel, road building. But looking closely at the massive machinery of a company like Deere, we have to ask, what happens when those neat, comfortable categories completely collapse in on themselves?
They blend together.
Think about the ultimate feedback loop we are entering. The physical, heavy, earth-moving equipment that is required to dig the trenches and lay the foundations for our digital future. The massive data centers housing the artificial intelligence is becoming fundamentally reliant on the very digital infrastructure it is helping to construct.
That's a trip.
You have a John Deere excavator digging a water main trench for a new data center campus, but that excavator's logistics, its preventative maintenance schedule, its GPS-grade control sensors are all being processed by an artificial intelligence living in a data center exactly like the one it is currently building.
A total closed loop.
The tractor mapping weed pressure with a satellite uplink isn't just a farm implement anymore. It is an active edge computing node in a global real-time network.
It's a server on wheels.
Exactly. The boundary between the physical economy of dirt and forged steel and the digital economy of code and the cloud hasn't just been blurred. It has been completely, permanently plowed over.
Well said.
And if you want to understand where the world is actually going next, you might want to stop staring at the stock tickers for the software companies and start looking a little closer at the massive machinery operating out in the field.
I couldn't agree more.
Thank you for taking this deep dive with us.